Chapter 8. We are in master budgeting here in managerial accounting. We are going to look at how a master budget is processed, and I think we understand why organizations have to budget, and basically as a result of budgeting, they've got to create various departmental budgets to know when various supplies need to be purchased and ordered. So with a managerial company, a budget is a detailed quantitative plan for acquiring and using financial and other resources over the upcoming period. A company's budget covers usually a one-year period. Some companies use what we call a perpetual budget that always is rolling forward. So there's always 12 months ahead of the schedule. Operating budgets usually cover a one-year period. Many companies divide their annual budget into 4 quarters. A continuous budget is a 12-month budget that rolls forward from 1 month as the current month is completed. They're used for planning what's going to happen in the upcoming period, developing objectives, and involves the steps of taking management increasing the likelihood that the objectives set down while planning get attained. So we want to plan, but we got to find a way to make it happen. So all parts of the company come together to make this happen. So what are the benefits? They define what their goals are and objectives. They try to communicate these plans in a budget. They coordinate the activities amongst all the departments so it can happen. See where they may have some issues to see where their objectives might not be realized by coming up with any bottlenecks in the various departments, and plan about the future. So here are the benefits. From a control standpoint, organizations compare their budgets to actual results. It just basically helps with the process of providing incentive to employees and helps improve the efficiency and effectiveness of the operation. So, a self-imposed budget or a participative budget is a budget that's prepared with help from all the various departments. It's going to more likely be utilized than those that just where management tells you, here's what you're going to do. So it's definitely a benefit in getting all participants on board. Self-imposed budgets come from the top down, but when managers get to work collaboratively to prepare a budget, these goals are likely to build a lower level management's confidence and commitment. It makes sense. They're a part of the decision making. Advantages of a self-imposed budget: it shows respect for their opinions when the individual departments get to have a piece in the decision making. Budget estimates prepared by frontline managers are usually going to be more accurate than those from up top. Motivation is going to be higher, and ultimately it gives them ownership in the whole process. Okay, so here's the deal. This master budget is a pretty big undertaking. You have to start with what you anticipate sales to be. Once you anticipate sales to be, then you can see you can then go with the production budget. And you have to have the ending inventory budget along with that. Then, once you've got the production budget, you can handle the various materials, direct labor, and overhead budgets. Once those happen, and you've got your selling and admin budget, then you got to come up with the money you need. How much money do you need each month to fulfill this? Then, once the cash budget is completed, you can then come up with your budgeted income statement and balance sheet. So it's a process. It's a series of steps that have to go into a certain order. To help you see the big picture, remember, 10 schedules in the master budget are designed to answer the 10 questions. How much sales revenue are we going to earn? How much cash are we going to collect? How much raw material will we need to purchase? How much manufacturing cost are we going to incur? How much cash will we pay to our suppliers and our direct laborers? And how much cash will we pay for the manufacturing overhead resources? What's the total cost that will be transferred from finished goods inventory to cost of goods sold? How much selling and admin expenses will we incur, and how much cash will we pay related to them? How much money will we borrow or repay to lenders, including how much interest are we going to have? How much operating income will we earn? And what will our balance sheet look like in the end? That's what we're doing this week. So we've got to have some various estimates and various assumptions in creating a budget. The sales budget requires 3 estimates or assumptions. What are the budgeted unit sales? What is the budgeted selling price per unit? And what percentage of accounts receivable will be collected in the current and subsequent periods? Microsoft Excel is the way to create a budget. So you can have various what-if scenarios embedded into your Microsoft worksheet. So we're going to do that to say, let's now look at creating a sales budget. Excuse me one sec. I'm just going to... This is another word for it. A lot of companies. How do we show the sales budget? Royal Company is preparing budgets for the quarter ending June 30th. So for the quarter ending June 30th, we've got budgeted sales of April to be 20,000 units, May to be 50,000 units, June to be 30,000 units, July to be 25,000 units, and August to be 15,000 units, with the selling price of $10 per unit. So we look at, in the sales budget for April, May, June, we show the budgeted sales, the price in units, and the total budgeted sales. Budgeted sales in units, the price, total budgeted sales. Then we have to determine, are we going to get cash or are they on account? In this scenario, all these sales are on account. They collect 70% in the month they sell the items, 30% in the month after. And then we have to know, what is the account receivable sitting as of March? So in March, the accounts receivable balance of 30,000 is important to know. We're going to be collecting that in April, because remember, these scenarios are still the same. That if they're planning on 70% being collected and 30 in the next month, in March, 70% must have been collected, so they're anticipating 30,000 to be collected in April. So you start then with knowing the $30,000 that's going to be collected in April. Then we know in April if we're going to have $200,000 in sales, 140 of it is going to be collected in April, 60 is going to be collected in May. Then we have to do the same with May sales, and we have to do the same with June sales. So guys, what will be the total cash collections for the quarter? If you look here, April, May, and the June, if we're going to collect 170, 230, and 500, should be 730, I am assuming. Well, that's not an answer, 940. Okay, what am I missing? 150, because in June, yeah, we're missing the June sales. So in June, okay, they didn't give us that. They're saying in June, they're going to be 300,000 units. So April, we're going to get the whole 200,000. May, we're going to get the whole 500,000. That's 700. June, we'll get 70%. 70% of 300 is 240, right? So 940 should be the total collections, right? Because this 300,000, 70% of it's going to come in. You're right, 210. So we should have all of the 200 coming in, all of the 500 coming in, and 210, 910. So what is the amount that should come in? 940. God, am I losing it? Okay. So it's the all of April, all of May, a portion of June, plus the 30% that came in of March's sales that came in April. Here we have Silver Company makes a product that is very popular as a Mother's Day gift. Peak sales occur in May of each year, as shown in the company's budget for the second quarter. From past experience, the companies learned that 20% of a month's sales are collected in the month of sale, another 70% are collected in the month following the sale, and the remaining 10% are collected in the second month following the sale. Bad debts are negligible, and we're not going to take that into account. February's sales totaled 230,000, and March sales totaled 260,000. So we're saying 20% come in the sale, 70, and then 10. Using Schedule 1, prepare a schedule of expected cash collections from sales by month and in total for the second quarter. So what is the accounts receivable? So basically, we're going to have to use, we'll have to use January's sales to show the 10% collection. So we've got here are our budgeted sales. Here's what we know we need for ending inventory. Here's what we know the beginning inventory is going to be. So this is what we've got to have in production of units. Fourth quarter, 70,000 units at 3 grams per unit. Expected cash collections. This is not expected cash collections. I'm going to pull this up real quick because that's not what I want. I just feel like it's not. Unit sales, added units of ending inventory goods. Let me just pull this up. I'm so sorry. I feel like that's not giving me what I want. Okay. I think I created this on my own. Expected cash collections. So exercise 8.1, we're just going to look at here because I feel like I just don't think that's adding up to what I'm trying to do. Okay. Well, exercise 8.1. This is more what I'm looking at. So what we want to do, we know February sales, 10% of February sales are going to come in April. Okay? We know for March's sales, if 70% come in April of March's sales, 10% come in May, we've got to show those two. For April sales, 20% are going to come in April for April sales, 70 will come in May, 10% in June. Then for May sales, we're going to get 20% in May, 70% in June, and then in June sales, we're going to get just the 20%. So even though sales peak in May, cash collections are going to peak in another year or in the next month, which is why we're going to need to borrow cash in order to satisfy what we need in cash to produce these goods. Okay? Does that make sense? So yes, this didn't give me what I wanted of expected cash collections. This was the wrong slide. Next. Now, this is where that slide we looked at. We are going to then prepare what we call a production budget in order to see what we're producing. So we completed our sales budget and what we expect our collections to be. Now the next step is to complete the production budget. The production budget shows with this company, management wants ending inventory to be equal to 20% of the following month's budgeted sales in units. So 20% needs to have already been finished goods for what we need to do for the next month. On March 31st, we had 4,000 units on hand ready for April. So 20% they want to show in ending inventory for what they're going to produce or technically sell the next month. So if budgeted sales here in April are 20,000 and they want to have 20% of May sales on hand, see what I'm saying? 20% of May sales they want on hand at the end of April. So if we started with 4,000 units, do you see how we need to produce 26,000 units? Meaning we know what we're going to sell. We want 20% of our ending inventory to be 20% of the next month's sales. We brought in 4,000, so we know what we've got to produce in April. Budgeted sales for May, if they're 50,000, we want 20% of those already produced as of the end of April. What is the required production for May? So let's look at that, guys. We need our ending inventory is going to be 6,000. Remember, 20% of June. So that's 56. Sorry. So we need 56. We will have 10,000 from the month before our beginning inventory. So wouldn't our required production be 46? The 50 plus the 6 in ending inventory based on 20% of 30,000, which is 56, minus our beginning inventory gives us our 46,000. Okay? Then, again, if July's sales are 25,000 units, then that means we need 20% or 5,000 units at the end of June on hand for the July sales. You see how they're figuring this out? They're just various assumptions, parameters that they're going to adhere to for beginning inventories and ending inventories. So here, if we look at exercise 8.2, down under products of Australia has budgeted sales of its popular boomerang for the next 4 months. It shows the April 50,000, the May 75,000, June 90,000, and July 80,000. The company is now in the process of preparing a production budget for the second quarter. Past experience has shown that end-of-month inventory levels must equal 10% of the following month's unit sales. The inventory at the end of March was 5,000. Required, using Schedule 2 as your guide, prepare a production budget by month and in total for the second quarter. So basically what we're going to do here, if we're going to start with 5,000 in beginning inventory, and we want on hand 10% of the next month's budgeted sales, you see budgeted sales of 50,000 units plus our desired ending inventory, 10% of the next month, then what our beginning inventory is. So we want 52,500 of required production in April. We'll follow the same thing through to May, through to June, and I believe they gave us July's at 80,000, so they want 88,000 on hand at the end of June. So this is our production budget. Okay? Prepare a direct materials budget, including a schedule of expected cash disbursements for purchasing materials. We see we need 5 pounds of material per product, per unit of product. Management wants materials on hand at the end of each month equal to 10% of the following month's production. On March 31st, 13,000 pounds of material are on hand, and it costs 40 cents a pound. So we go, here is what we're going to produce from the production budget. We need 5 pounds per unit to give us what we desire. We show what our ending inventory is going to be, 10% of what we produce in May. Okay? We know our beginning inventory from the end of March. So we've got here, let me just see, we've got the April showing what we need to have on hand, 10% of May's production. We've been given what came in from March's ending inventory. So here our March 31st inventory is the 13,000. Why don't you calculate the materials to be purchased in May? So what would the materials be that we need to purchase in May, guys? I want you to attempt that. Anyone know?
So for the desired ending inventory, it would be 14,500.
Okay.
And then you add those two together to get 244,500.
Okay.
And then after that, you add the 23,000 from that.
Yep.
Add them all together to 267,500.
Okay, let's see where we're off.
Oh, subtract it?
Yeah,
Oh, okay, that's right.
because you already have that on hand. But close.
Yeah, I just ended up adding on stuff.
And then you see for the quarter what's needed in production. Excuse me one sec. Okay. Royal pays 40 cents per pound for its materials. 1/2 of a month's purchases is paid for in the month of purchase. The other half is paid in the following month. The March 31st accounts payable balance is 12,000. Now what we're going to do is try to figure out expected cash disbursements for the materials. So we've got 12,000 is due in April. We show, based on how much we need in product, 50% is going to be paid in April, 50% of it's going to be paid in May. What are the total cash disbursements for the whole quarter? So I'm just going to show you because we just got to go through the things. We've got May purchases, 50% is going to be paid in May, 50% in June. June's purchases, 50%. So you see, we need $185,000 of cash disbursements just for materials. Okay? Okay. 3 grams of musk oil are required for each bottle of Mink Caress, a very popular perfume made by a small company in western Siberia. The cost of the musk oil is $1.50 per gram. Budgeted production of Mink Caress is given below for quarters for year 2 and for the first quarter of year 3. So here we show the oil, 60,000 bottles for the first quarter of year 2, 90,000 for the second, 150 for the third, and 100,000 for the fourth, and 70,000 for the first year of year 3. The inventory of musk oil at the end of a quarter must be equal to 20% of the following quarter's production needs. Some 36,000 grams of musk oil will be on hand to start first quarter of year 2. So first quarter of year 2, we're going to have 36,000 grams. Using this schedule, prepare a direct materials budget for musk oil. So we started with 36 grams. In the second quarter, how much do we need to have on hand? We want 20% of the following quarter production needs. So third quarter, we're going to need, if we have 150,000 bottles in production, we're going to need 20% of that musk oil on hand, and we use 3 grams. I believe that's what they said, 3 grams per, so 450,000 there. So you see, for the first quarter, we need 180,000. We know what came in was 36,000. We want to have on hand, what did they say? 20% of the next quarter. So if we want, in this case, for the second quarter, we want 20% of 90,000 bottles, which is at 3 grams a bottle, 270,000 grams, right? Let me just see. 90,000 raw materials, 3 grams, 70,000 units times 3 grams times 20%. So 90, 270 times 20%, 54,000 here. And then the cost is $1.50 per gram. So this shows the materials that need to be purchased in just the mink oil for the quarter. Make sense, guys? Yes? Now we've got our production budget, our materials budget. We're going to now look at our direct labor budget. At Royal, each unit of product requires 0.05 hours, 3 minutes. The labor can be unskilled because the production process is simple and formal training isn't required. Royal pays $10 per hour. So 3 minutes technically we should be able to get 20 bottles, right? An hour. From the production budget, if we see the units of production here, and we see the amount of time to be spent per unit, we need 1,300 labor hours. At $10 a labor hour shows our direct costs in labor, 13,000, May 23,000, June 14,500. Okay? Then a manufacturing overhead budget at Royal, manufacturing is applied to units of product on the basis of direct labor hours. The variable manufacturing overhead rate is $20 per direct labor hour. Fixed manufacturing overhead is $50,000 per month, which includes $20,000 of non-cash costs, which is depreciation. So if we know our direct labor hours, and we then know it's at $20 per direct labor hour, we figure out our variable manufacturing overhead costs. They told us our fixed manufacturing overhead cost of $50. So we've got our total overhead here of $76,000. Now, here we can see, if we look at our total manufacturing overhead for the quarter of $251,000, and we look at how many labor hours are required here, we can come up with a per hour cost of total manufacturing overhead by just taking our 251 here and dividing it by our direct labor hours of 5,050 to come up with $49.70 is the manufacturing overhead cost per direct labor hour. So when we talk about cash we need, though, since they told us 20,000 of that 50,000 is non-cash depreciation, we can subtract that out of our cash budget since that's a non-cash issue there. Okay? Okay. Now, our ending finished goods inventory budget, if we know that each pound is 40 cents a pound and we need 5 pounds of product per unit, we know we need $2 of product per unit. The direct labor, we need only 3 minutes per hour, per direct labor hour, which gives us 50 cents there. Our manufacturing overhead, we know 3 minutes at $49.70 per hour provides us with $2.49. So do you see the cost to produce 1 unit is $4.99? So how do we budget our finished goods inventory? We're going to show ending inventory that will show in units, 5,000 at our cost of $4.99, shows us what is sitting in cost in ending inventory. Okay? This is listed from the production budget. So this is where this figure comes from. The direct labor budget of Well Corporation for the upcoming fiscal year contains the following data concerning budgeted direct labor hours. So we see we're budgeting for the first quarter 8,000 hours, second quarter 8,200 hours, third quarter 8,500 hours, fourth quarter 7,800 hours. The company uses direct labor hours as its overhead allocation base. The variable portion of its predetermined manufacturing overhead rate is $3.25 per direct labor hour, and its total fixed manufacturing overhead is $48,000 per quarter. The only non-cash item included in the fixed manufacturing overhead is depreciation, which is $16,000 per quarter. Using Schedule 5 as your guide, prepare the company's manufacturing overhead budget for the upcoming fiscal year. So we see if we take $325 in the variable manufacturing plus $26,000, plus the $48,000 per quarter, we need to subtract out the depreciation since that's a non-cash issue to show what our manufacturing overhead cash budget is per quarter. Does that make sense? How do we compute the company's predetermined overhead rate? If we take our total manufacturing overhead for the year divided by our budgeted direct labor hours should give us our predetermined overhead rate. Okay. Now, after all of that, we're going to prepare a selling and admin budget. The selling and admin budget, it's divided into variable and fixed components. The variable selling and administrative expenses are 50 cents per unit sold. The fixed selling and administrative expenses are $70,000 per month. So, the fixed selling and administrative expenses include $10,000 in depreciation that are not cash outflows. So here we show our budgeted sales that then give us our variable selling and admin plus our fixed selling and administrative. Take away the depreciation to show us our cash expenditures for the month of April. What are the total cash disbursements and selling and admin expenses for the quarter? So we know we'd have to go back and find the budgeted sales for each one. But basically, here are your budgeted sales times your 50 cents. Add your fixed, subtract the depreciation to come up with those sales. How's everyone doing? Boring? Selling and admin budget, exercise 8.6. Weller Company's budgeted unit sales for the upcoming fiscal year show First quarter, $15,000. Second quarter, $16,000. Third quarter, $14,000. Fourth quarter, $13,000. Variable and selling admin is $250 a unit. Fixed selling, $8,000 per quarter, $35,000 for executives, and depreciation of $20,000 per quarter. In addition, the company will make insurance payments of $5,000 in the first quarter and the third quarter. Property taxes of $8,000 will be paid in the second quarter. So here you see your variable, selling and admin. You see your fixed selling and admin, and 2 insurance payments in first and third, property taxes in second. We subtract out the depreciation to see what our cost budget is for selling and admin for the year. Make sense? It's a progression. It's really straightforward. It's just taking each, it's putsy. Okay? Now, after all that, we then can prepare a cash budget. The cash budget is divided into cash receipts, cash disbursements, cash excess or minus, then the financing section. So, for Royal, let's say Royal maintains a 16% open line of credit for $75,000, must have a minimum cash balance of $30,000, borrows on the first day of the month and repays loans on the last day of the month, pays a cash dividend of $49,000 in April, purchases $143,700 of equipment in May and $48,300 in June, and starting April has a cash balance of $40,000. Okay? So, we start with a cash balance of $40,000. We know we're going to anticipate receiving $170,000 in cash in this month. Then we need to go and pull from the materials budget, the direct labor budget, the manufacturing overhead budget, the selling and admin budget, and then they did tell us dividends were going to be paid out in April. So do you see we need on hand $228, but we only are going to have $210? So we're in the hole $18,000, which means we need to go borrow. If we want a $30,000 balance on hand, and we're in the hole $18,000, that means we need to borrow $48,000. Okay? That makes sense? So now, starting in May, we're going to have $48,000 on hand. We're going to have $30,000 on hand. We had to meet with our deficit. So we started with $30,000 on hand. Here's what we anticipate expecting to receive in May in cash. Here are our outflows of cash. And in this case, we've got $30,000 sitting in excess. But we always want to keep at least $30,000 on hand. What is the excess deficiency of cash available over disbursements for June? Well, we're going to show what we started the month with, what we expect our cash inflows to be, less our outflows. So this looks like we're going to have $130,000 sitting on hand at the end of June, which means we get to pay back our money, right? We get to pay back what we borrowed along with the interest. So ultimately, after we pay back that money, we're going to sit with $80,580 on hand. Okay? So now, after we've done that, we get to do our budgeted income statement. Garden Depot is a retailer that's preparing its budget for the upcoming fiscal year. Management's prepared the following summary of its budgeted cash flows. So we see cash receipts and we see our cash disbursements. The company's beginning cash balance for the upcoming fiscal year will be $20,000. The company requires a minimum cash balance of $10,000 and may borrow any amount needed from a local bank at a quarterly interest rate of 3%. That's quarterly. Normally they tell us annually, okay? For financial accounting, everything was annually. They're telling us 3% a quarter. The company may borrow any amount at the beginning of any quarter and may repay its loans or any part of the loans at the end of any quarter. Interest payments are due on any principal at the time it is repaid. We're not going to say it's the interest rate's compounded. Using Schedule 8, prepare the company's cash budget for the upcoming fiscal year. So we know what we started with. We know what our inflows are, outflows are. Here's our deficit. So we've got to borrow, in this case, $70,000 since they want at least a $10,000 ending balance. Okay? For second quarter, we know what we start with. We know our inflows, outflows, where we're sitting. We can pay back that money we borrowed in the first quarter. Okay? And our interest on this $4,200, the company must borrow $70,000 to maintain its desired with a balance of $10,000. $70,000 times 3% times 2 quarters is $4,200 there. Okay, because they borrowed it over the 2 quarters. We're trying to keep it real simple. I mean, you know and I know it doesn't work that way. But anyway, we're starting third quarter with a $35,800 beginning balance. We show our inflows, our outflows, and where we're sitting. Fourth quarter, the same. We're starting with $25,800. Our inflows, our outflows, we'd be sitting then with $15,800. Okay? Prepare a budgeted income statement. So basically, this is for the quarter. Our unit sales, our cost of goods sold, our selling and admin, the interest we're going to have to pay because of borrowing money, and that should be our net income. Again, these all come from various budgets. So, for us to do a budgeted income statement, Gig Harbor Boating is the wholesale distributor of a small recreational catamaran sailboat. Management's prepared the following summary data to use in its annual budgeting process. So we've got our selling price per unit, our cost per unit, variable, admin per unit, fixed for the year, and then the interest expense. So we can show 460 units times $19.50 a unit, our cost of goods sold per unit for the total. Then we've got our gross margin. We've got our selling and admin to be the variable plus the fixed. We've got our operating income minus our interest expense gives us our net income. Okay? Then we have to do a balance sheet. We've got our various items here: land, $50,000, common stock, $150,000, retained earnings. As of April 1st, we're showing that to be $248,650, and equipment of $175,000. We know we'll have the cash on hand as of June 30th. We know our June sales, 30% of those aren't going to be collected until the next month, so we have that as the receivable. We've got the raw materials inventory on hand, our finished goods on hand, our land equipment. Here, our common stock retained earnings was given to us, and our accounts payable, we owe 50%. We pay 50% in 1 month, and we pay 50% in the next month, so we know what we'll owe in accounts payable. That's our budgeted balance sheet, and we are done. Assets, beginning balance, add our net income, subtract our dividends, gives us how we come up with the retained earnings. So, here we've got Mecca copy. We've got our accounts receivable, supplies inventory, equipment, accumulated depreciation, accounts payable, common stock. It tells us the beginning balance of retained earnings was $28,000. Net income's budgeted to be $11,500, and dividends are budgeted to be $4,800. What would that make our retained earnings, guys? $34,700. Okay? So the only plug-in we have now is cash. So if $34,700 is our retained earnings, we can put everything else in here, and we can plug in our cash of $12,200. Okay? Exercise 8:17. Wheeling Company is a manufacturer that provided a balance sheet as of September 30th, as shown below. So we've got our cash, accounts receivable, inventory, buildings and equipment to come up with our total assets of $395,400. Then we've got our accounts payable, common stock, and retained earnings to then come up with completed balance sheet here. The company's in the process of preparing a budget for October and has assembled the following data. Sales are budgeted at $240,000 for October and $250,000 for November. Of these sales, 35% will be used for cash, and the remainder will be credit sales. 40% of a month's credit sales are collected in the month of the sale, and the remaining 60% is collected in the following month. All of the September 30th accounts receivable will be collected in October. The budgeted cost of goods sold is always 45% of sales, and the ending merchandise inventory is always 30% of the following month's cost of goods. All merchandise purchases are on account. 30% of all purchases are paid for in the month of purchase, and 70% are paid for in the following month. All of the September 30th accounts payable to suppliers will be paid during October. Selling and admin expenses for October are budgeted at $78,000, exclusive of depreciation. These expenses will be paid in cash Depreciation is budgeted at $2,000 for each month. So the way in which we're going to calculate this, using the information provided, calculate or prepare the budgeted cash collections for October. Did I not put these in? I didn't even give the answers. Oh my gosh. So let me go in here. 8, was that 17? So for 8/17, the cash, 59,000, let me just look here. The 59,000 right here, the 59,000 plus these October and November, 35% will be collected in cash. The remaining are credit sales. 40% of a month's credit sales are collected in the month of May and 60% collected in the following month. So we know then if 35% of each of these are cash, and then 40% is going to be collected in that month also. Here we can see the 59,000 plus the 236,400 minus what we're paying out, the 105,805 minus the 78,000, and those, I'm sorry I did not have this finished. Cost of goods sold is always 45% of sales, and the ending merchandise inventory is always 30% of the following month's cost. All merchandise purchases are on account. 30% of all purchases are paid for in the month, and 70% are paid for in the following month. So the budgeted cash collections, the budgeted merchandise purchased. So the budgeted cash collections here, here's our balance sheet. But the budgeted cash collections in $240,000 at 35%. September credit sales collected in October are $90,000. October credit sales collected in October are $78,000. So we see here our $252,000 here in our purchases, our cash collections. The merchandise purchases, we're going to show 45% of the budgeted cost of goods sold. We're going to pay out. Our ending merchandise inventory, the $250,000 at 45%, and then 10% of that gives us what we need, less what our beginning inventory is going to be to show what we need to fork out in cash disbursements. The cash disbursements for merchandise purchases are going to be September credit purchases paid in October, October credit purchases paid in October, to show what's being dispersed, outflows there. The net operating income, we're going to see our sales minus our cost of goods sold, which is 45%. Then our admin gives us our net income. And then our balance sheet is going to show us how we increased our retained earnings, what our inventory needs to be at the end of the period, what our accounts receivable will be at the end of the period, and our cash. So guys, in a nutshell, this is the entire chapter. It's easy, it's just there's a lot of pieces to it. Okay? If I go back to this question they did ask, budget cash collections, assume the following changes. They changed some of the numbers, but basically compare your answers to those you've obtained. If Wheeling is able to achieve the budgeted projections described in this second piece, will it improve the company's financial performance? So basically, you initially created it, and then from there, they wanted you to change how they were collecting cash to see if things would be better for that. And they said cash flows and working capital management. They're just, you need cash. You need the cash to produce, to manufacture the goods. Students may be inclined to conclude that the financial projections in requirement 2 indicates a decline in performance because the net operating income is the same, but the assets drop. This overlooks the importance of cash flows and having working capital management. So, guys, that in a nutshell is for this chapter.